In a world where economic uncertainty looms, a remarkable trend has emerged, captivating economists and investors alike. Today, we embark on a journey to unravel the enigma, how the job market is defying economic gravity. Against the backdrop of a slowing economy, a surprising resilience persists in the U.S. employment market. In May alone, non-farm payroll employment exceeded expectations, growing by 339,000 jobs. This steady pattern of job growth defies conventional wisdom, leaving experts astounded. The state of the employment market in the U.S. has raised eyebrows. Despite a decelerating economy, we continue to witness solid job growth and impressively low unemployment rates. It's an intriguing puzzle that requires further examination. While the unemployment rate experienced a slight increase to 3.7%, a jump from the previous month's 3.4%, it still remains near historic lows. But what does this contrasting data mean for the economy at large? Recent trends in the job market may signify that we're still navigating the complexities of this post-pandemic era. The relationship between economic performance and employment dynamics may be undergoing a transformation. What do these remarkable trends tell us about the trajectory of the job market? How will the Federal Reserve respond as it steers monetary policy in the face of uncertainty? And perhaps most importantly, what implications do these insights hold for investors as they navigate the remainder of the year? Welcome to the General Finance channel, where we're committed to helping you take control of your finances. Are you tired of feeling overwhelmed by credit card debt, unsure of how to create a budget, or intimidated by the world of investing? Don't worry, we've got you covered. Our channel is dedicated to providing you with practical tips and insights on credit management, budgeting, and investing. We upload new videos 3 to 5 times per week, so you'll always have fresh and valuable content to help you achieve your financial goals. If you like what you see, make sure to hit the like and subscribe button, as well as the notification bell so you never miss out on our latest uploads. Let's start our journey to financial freedom together right here on General Finance. As we delve deeper into the perplexing puzzle of the job market's resilience, we now shift our focus to the first piece of the enigma: job growth, solid but slowing. Throughout 2021 and 2022, the economy experienced rapid job growth, with an average of 339,000 jobs added per month. While this pace was slower than the previous year's remarkable growth, which exceeded 605,000 jobs per month, the recent numbers remain impressive. However, beneath the surface, signs of a weakening trend begin to emerge. Despite the slowing economy, the job market strength remains steadfast. The unemployment rate, standing at 3.7% in May, has remained relatively stable since early 2022. In contrast, gross domestic product or GDP growth has accelerated, reaching a mere 1.3% annualized rate in the first quarter of 2023. Job openings have experienced a recent decline, reaching their lowest level in nearly 2 years. However, a glimmer of hope emerges as job openings slightly rebounded in April. With elevated job openings and 5.5 million Americans actively seeking work, the ratio stands at 1.8 jobs for every unemployed individual. The trends observed in recent jobs reports appear to reflect the Federal Reserve's efforts to slow down the job market. Rising labor costs, which can influence broader inflation measures, have captured the attention of the Fed. Wage growth pressures seem to be easing. We've seen more people re-entering the workforce, and if these trends continue, they could potentially push wage growth down, a positive trend for inflation. The ongoing strength of the job market may seem perplexing, given the Fed's efforts to slow the economy. Yet this complexity arises from the significant changes the workforce has undergone since the pandemic's onset. The impact of the Fed's actions does not immediately reverberate throughout the broader economy. The aftermath of COVID-19 continues to necessitate adjustments, and growth in jobs has not fully rebounded as expected. Additionally, certain industries still grapple with a shortfall of workers, as the pandemic caused many employees to leave their positions or face layoffs. Some jobs have not returned as swiftly as anticipated, particularly in the services and healthcare sectors, where numerous positions remain unfilled. The job market's path, solid yet slowing, raises further questions. What lies ahead? How will these trends shape our economic landscape? The Fed, in its endeavor to combat inflation, embarked on a remarkable journey of raising interest rates. But what does the job market tell the Fed about the path ahead? Matt Shopner, a senior economist at U.S. Bank, has said the Fed's decision to aggressively raise interest rates was driven by a sense of urgency. They were late to the game in addressing the inflation issue that emerged in early 2021. The central bank understands that the impact of their actions takes time to ripple through the economy and create substantial changes in business and consumer spending. The Fed's short-term Fed funds target rate climbed steadily from near 0% before March 2022 to a range of 5% to 5.25% by May 2023. While there may have been indications of a potential pause in rate hikes, the prospect of immediate interest rate cuts remains dampened. The Fed is walking a tightrope, aiming to maintain its current policy stance designed to combat inflation without triggering a recession. A job market plays a crucial role in informing their decisions. The conundrum deepens. A job market's resilience, coupled with the Fed's efforts to tame inflation, presents a delicate balance. But how do these factors relate to one another? The ongoing strength of the job market, with solid job growth and a relatively stable unemployment rate, challenges the notion of a weakening economy. However, the Fed's proactive measures suggest that they're addressing an inflation issue that emerged earlier. So as the job market continues to send mixed signals, the Fed finds itself at a crossroads. Challenges in the labor market. A job market strength presents the Fed with a conundrum as they strive to achieve their objectives of full employment and taming inflation. But what exactly is at the heart of this challenge? The Fed's focus lies in the growth of wages. Can they successfully navigate the delicate balance between achieving full employment and reducing inflation? It's a question that remains unanswered. Recent months have seen a slowdown in wage growth, with the rate standing at 4.3% in May 2023. However, the Fed's target annual wage growth rate falls within the range of 3.5%. One key aspect of reaching the desired wage growth rate is the improvement in the labor participation rate. There's still a need to entice more workers back into the job market. With a rapid pace of job creation and a surplus of available jobs compared to the number of workers, labor costs remain elevated. This is undoubtedly a consideration for the Fed as they contemplate further rate hikes. However, the challenges in the labor market extend beyond wage growth. A longer-term concern arises when examining productivity, the measure of output in relation to inputs such as capital or labor. The information age brought significant advancements in productivity, but the landscape has changed. While we still see improvements, the impact on job creation and economic growth has diminished. This raises important questions about our expectations for future economic growth, especially if both productivity rates and the size of the labor force advance more slowly. What do we expect going forward? As we conclude our journey through the enigmatic relationship between the economy and the labor market, what can we expect in the days to come? If the economy continues to slow, we may witness a corresponding weakening in the job market. The impact of rate hikes takes time to permeate the economy, which suggests that the pace of new job creation could further decelerate in the coming months. Recent announcements of significant layoffs in the technology sector, along with an uptick in initial jobless claims, are potential indicators of a shifting tide. While jobless claims have not yet reached concerning levels, they reflect the effects of the layoff announcements we've been hearing. These developments may shape the path ahead for the Federal Reserve. If jobless numbers indeed rise, it could sway the perspectives of Fed policymakers, possibly leading them to reconsider their approach to interest rate hikes in the upcoming months. The next crucial decision-making moment for the Fed lies within the mid-June 2023 meeting of the Federal Open Market Committee. The future remains uncertain, and the path ahead is filled with twists and turns. The labor market, intertwined with the broader economy, continues to perplex and surprise us. Will the Fed find the delicate balance between economic growth and inflation? Can the labor market sustain its resilience? These questions will shape the narrative as we navigate the complexities of our financial landscape. Thanks for tuning in to today's video on the General Finance channel. We hope you found it informative and valuable. Remember, we'll be posting new videos on the channel 3 to 5 times per week, so make sure to hit that subscribe button and turn on notifications so you never miss an update. And don't forget, we want to hear from you. Leave your thoughts and feedback in the comments section below. Is there a particular topic you'd like us to cover in a future video? Let us know. Thanks again for watching, and we'll see you in the next one. Keep building that financial savvy, and we'll be here every step of the way to help you on your journey to financial freedom.